for joining our review of the third quarter of 2024. I'm going to talk today about markets after the third quarter. We're also going to touch on interest rates, possibilities of a recession, and of course, I'm getting a lot of questions on the upcoming U.S. election and what that will mean for people's finances. I'm joined today, happily, by Jonathan Lowe. He's a senior equity analyst at AGF Funds. Welcome, Jonathan.
Thanks, Brian. Happy to be here and happy to join everybody on the line who may be tuning in. My name is Jonathan. I'm Vice President Growth Equities at AGF, as well as Senior Equity Analyst. I've had a chance to actually get to know Brian in the last several months, and it's been a great friendship so far. So I'm really happy to be here to talk about anything, quite frankly, Brian. Whatever you want to talk about, we're all open.
Great. Okay. Maybe I'll just ask you, so you're with AGF. How long have you been there? What's your role there?
I've been at AGF for 12 years. I've been Vice President Growth Equity. So I'm a senior person within the growth equity mandates. So we manage about $14 billion today across three portfolios, one being the flagship fund for the firm. So AGF's initials stand for American Growth Fund. That's the first U.S. equity mutual fund launched for Canadian investors. And that's the largest mandate that we manage. I'm also on the AGF Global Select mandate, which is Canada's fastest growing global equity fund in the last 5 years as well. And we also manage a U.S. small mid cap portfolio, so it's a smaller portfolio. Okay, great. That's pretty impressive, and I'm super glad to have you today. So you can see by my backdrop, I've got this is a New York City backdrop. My wife is American, and this is right near my mother-in-law's apartment in New York. So in time with the U.S. election, I had that up, and I'm getting a lot of questions and concerns about the U.S. election. Do you have any general thoughts about how it's going to affect equity markets? Yeah, it's what a time to be alive in this era of political polarization, I guess. But I guess what I would first say when it comes to elections, geopolitical events, is that generally any geopolitical event, whether they be elections or wars or terrorist attacks, historically they've had, a short-term impact on equity markets. So severe events can cause a 3 to 6 month period of volatility, but historically, when you look at 12 months after that event, the market tends to move on and focus more on the economic cyclical factors. So I think that's a truism that we have to keep in mind when we're thinking about things like the election. Historically, the markets haven't really deciphered much between who wins the election. Actually, historically, election years, equity markets have done slightly better when Republicans win, but the difference is really de minimis. The key point is really that the markets tend to actually rise in election years after experiencing some period of volatility. Did you know, by the way, Brian, that the first 960 days of Trump's presidency, the S&P 500 was up 63%. Okay, and the first 960 days of the Biden presidency, the S&P 500 was also up 63%. So, I think that, the election, whoever wins, is less consequential. Actually, one key thing to keep in mind is that split results do tend to be more positive for equity markets. So then that's when one party takes the White House and the other party has control of one of the houses of Congress. That does tend to be associated with better equity markets. Gridlock is good for stocks because it means more certainty, less upheaval in terms of policies, and certainty is a good thing for investors. Now, this time around, I think that equity markets have had a really strong year. Obviously they have. There could be some volatility around the election. Yesterday, I think I saw that Ray Dalio said that there's a 50-50 chance that Trump is going to contest the election if he loses. I think he's exactly right on that. In fact, I would say the odds are even higher than that. So a contested result, if there's a tie or close to a tie, that could result in a short-term period of volatility. But I think that as long as a president is clearly inaugurated in January, and by the Constitution it has to be, then I think that volatility is just going to be short-lived. So now, for the overall market, the election doesn't tend to really drive results, but underneath the surface, in terms of sectors, there are some differences. There's also some similarities. So the similarities, I would say, are first deglobalization. So both parties are going to be tough on China. Another similarity is that you can expect the fiscal spending and the fiscal deficit spending in particular to continue because the Democrats have been, have shown a propensity to spend. Trump wants to cut corporate taxes further. Either case, we're going to see the debt and the deficit balloon and grow. I think the difference is one of the big ones would be deregulation. So Trump is more likely to deregulate in sectors like financials and energy. So I think in the case of banks anyway, that could be a positive, slight tailwind. But I would caution that around the obvious winners around policy. So I often like to say that the market is a great equalizer. If you just think about recent history, when Trump was elected in 2016, everybody thought that's going to be great for energy and the end for sustainability stocks. And actually what happened in the next 4 years was the exact opposite. It was the best 4 years ever for sustainability stocks and a terrible period for energy.
Right.
And then Biden got elected in 2020 and people thought the exact opposite, right? Like it was the end. It was the end for energy and a new day for sustainability stocks. And then in the last 4 years, exactly the opposite happened. It's been a tough time for sustainability. And energy has done tremendously well over a several year period. So I think when Trump says something like "drill, baby, drill," it may not be the boon for energy companies that it may seem. I think more important is really the supply and demand dynamics within that sector and the economic cyclical factors that are prevailing at any given time.
Yeah. Okay. Those are all very good points. That's interesting. I would agree on the election front. I mean, markets hit record highs under Obama. They hit record highs briefly under Trump, and then collapsed a bit during the pandemic, of course, and they've reached record highs again. So the election as a side issue doesn't worry me that much. It's more we've had 2 really good years in markets, and at some point, 1 out of 3 or 4 years, there's a negative year. 2022 was a very negative year, so I'm risk averse by nature. So I suspect we may see volatility just in, people even transitioning from sectors and the enthusiasm for tech stocks. Some of them more than, some of them have better earnings than others, but enthusiasm for certain stocks may decline. So there'll be some sector things. On that note, do you see sector changes happening? I know since June we saw some movements in sectors from text to value, or see that continuing, or?
Yeah, absolutely. So let me first, I want to make a comment on your comment about volatility. So volatility is normal. We get on average 3.5%, 5% corrections per year. You get over 1.1, actually 10% corrections per year. So these episodes are normal. I think when what we really want to avoid is the volatility that's associated with a recession, because bear markets associated with recessions have averaged historically anywhere between 30 to 35% declines, and some have been worse than that. And I'm sure you can recall, some of that are worse. And so, what we pay a lot of attention to is where we are in the economic cycle. And I think when we look at the fundamentals related to the economy today, the U.S. economy in particular, which is about 2/3 of the global economy, it's still in a pretty good spot. If you look at the real GDP metrics all year long, they've been around 3%. So in the first quarter, we came in below 3%. But if you add back trade and inventories, the effect of that, final domestic demand right around 3%. Second quarter came in at 2.8%. The current Q3 reading for Atlanta Fed GDP now is 3.2%. So we've been growing at around 3%. That is fine. That is healthy. It is fine for equity markets to do well. Now on your question about what's changed. So the biggest thing that's changed, Brian, recently is that we've started a rate cutting cycle. And now, why have we started a rate cutting cycle? Well, I mean, the Fed has a dual mandate. So they're responsible to look after 2 things. The first is inflation, and the second is employment. So let's tackle each one of those things. Inflation is coming down. We've been solidly on a disinflationary track for some time now. PCE is down to 2.5%. Core CPI also down to below. It's trending down. The components of it are also trending down. And so, we've been on this track for some time and getting close to the Fed's target. Now, employment, on the other hand, has also been softening. So we've softened from very strong levels and very tight levels to more normalized levels. Currently, if you look at the 3-month moving average for non-farm payrolls, which is the number of jobs created per month, it's at 186,000 jobs, which is lower than where we were 2 years ago, but it is actually really close to where we were before the pandemic. The pre-pandemic average was 190,000 jobs. So we've basically gone from very tight labor market to more normalized one. Did you know that right after the pandemic, there was a period when there were 2 job openings per unemployed persons? That is completely abnormal, by the way. I mean, just think about it. If you get unemployed and there's 2 jobs waiting for you, no wonder you're looking for higher wages to combat inflation. So that really feeds that inflationary loop. Well, that's been normalized, where we're back down to one job opening per unemployed person, and so that's a good thing. So now the Fed has started cutting rates, and so we are seeing some shifts in the equity markets. So when you look at what's done well, since June, and I think July is really when the market started to look to really start to price in that we're on the cusp of a rate cutting cycle. And in September that became true. Well, if you look for 12 months after the first rate cut by the Fed, there's the 2 things to keep in mind. First of all, whether or not there's a recession in the next 12 months. And if there's no recession, then that's actually a great time to be invested in stocks. Historically, if you have a rate cutting cycle and no recession in those next 12 months, the 12-month average return is 20.5%, over 20%, 12 months later.
Okay.
Now, what does well in a soft landing scenario, I think, is a couple areas that we like. One is consumer discretionary, actually. So it goes without saying that consumers have struggled for several years now with high inflation, higher rates. And so lower rates is welcome relief to many of those consumers. So there's certain areas within the consumer sectors that are much more interest rate sensitive. For instance, housing is one of them. And so housing related stocks have been looking much better recently. The second one is healthcare. Actually, healthcare, by the way, is the sector that has had the highest consistency in terms of outperformance 12 months after a rate cut. It's done so in each one of the last.
Why would that be? Maybe I'm just down here. I'm just not getting the consumer stuff I can see, but healthcare, how does that tie into rate cuts?
So healthcare is sort of a bifurcated sector. There's both compounders within healthcare, meaning these are steady stocks that our plays are basically long-term trends like demographics.
Okay.
A managed care company, for instance, is one of those. And so when the Fed cuts rates, there's a couple scenarios. One is that there's something bad happening in the markets, and so when something bad's happening in the markets, that the defensive area of healthcare actually does very well. Now, when healthcare also has a more binary part of the sector, which is like biotech, med tech, et cetera, and when the Fed cuts rates and achieves a soft landing, it doesn't happen so very often, but it looks like we're on the track of one right now. Those areas do well because they're very interest rate sensitive. They're earlier stage kind of companies, and so they've tended to do well. So healthcare actually is the only sector that's outperformed 12 months after the first rate cut in each of the last 4 rate cutting cycles. And so I think, and when you look at healthcare, there's other reasons to like it. Earnings are inflecting higher. And it's really an area of a lot of innovation today. Just today, actually, this morning, one of our top 10 holdings is a company called Intuitive Surgical. So they are the leader, the runaway leader in robotic surgery. And they reported great results. They have their 5th generation machine. There's a strong uptake on them. That's an example of tremendous innovation. These machines perform surgeries in a much more surgical fashion, for lack of a better term. What does that mean? It means that your incisions are smaller, and so your recovery time is quicker, and so your hospital stay is shorter. And so it's good for the doctor, it's good for the patient, it's good for the hospital, it's good for everybody in the healthcare ecosystem.
Right.
So we think that the addressable market, when you're looking at any healthcare stock, you're thinking about the addressable market of its end product. It's going to be enormous, and so that's an area that we also like a lot.
Yeah. I mean, in the background of all this, like we've had a lot of global events, of course, the pandemic. We've had an invasion of the Ukraine, inflation, fears of recession. Even 6 to 8 months ago, I think was like one of the number one fears in inflation. Now it's the economy, which is a more general fear people have in general. But innovation continues in the background throughout all
Yeah.
this, and it improves profitability, improves life for people. So it doesn't get the news every day, except for the sort of tech stock enthusiasm. But that's a great story you've told. Um, so you've stolen my questions about interest rates and inflation already, but I think we agree that inflation is definitely coming down, if not come down. Unfortunately, people's prices have gone up. We're not going to see deflation, so those prices are not
Right.
going to go down, but at least we're in a more normalized scenario.
Yeah.
And I'm guessing wages, hopefully, for a lot of people would have increased with inflation
Yeah, we
with
have seen
everything,
actually
or
pretty decent wage inflation metrics, given the labor market, what's happening in the labor market. I think that when it comes to inflation, I understand. Like I hear that from my wife all the time
Mhm.
about how grocery prices are higher, and the fact is that when we measure inflation in markets, it's a rate of change, right?
Mhm.
It is a year over year rate of change.
Mhm.
Therefore, we're trying to get back down to 2.5% inflation or 2% inflation. That doesn't mean
Mhm.
prices are going down. The cumulative
No,
effect of inflation that's already occurred has eroded
no,
purchasing
that's the
power.
issue. They're not going
That's
back, and it affects different people differently. If you're low
right.
income and your wages haven't increased, then whether it's the price of eggs or milk or a screwdriver, if it's gone up 50% over 7 years, whatever, you're still feeling that. Other people, seniors, were getting 1% on GICs for the last 2 years and been getting 5%.
Yeah.
So their income has gone up, but will go down. Pension plans generally, if they're indexed, have gone up. So if you're in that scenario, but at the street level, there's definitely a lot of concern that they're losing.
Mhm.
But other people have winning and been making money on bonds. Do you have any brief thoughts? I don't want to go on all day, but about fixed income markets, do we still see bonds as attractive in portfolios, or as interest rates? I mean, as interest rates drops, the price goes up of them, but gradually you get in a scenario where the rates are down, they're not dropping anymore. Um, are people going to move back to stocks at some point because of that? That they end up getting 2% on a bond? And similarly, people are, as we talked about the other day, people have flooded money. There's tons of cash on the side
Mhm.
right now where people are in money market funds. Like it's a huge number, like $1 trillion or some crazy number. Am I right?
Yeah, there's
On the sidelines. So that should feed stocks as being more attractive as people look to dividends with higher yields if they go back to getting 1%, not 4.5, 5% on a money market.
yeah, I think so. Let me start with that last point. There's been tremendous flows into money market instruments over the last several years.
Mm.
And Brian, you probably have a few clients who have asked you about that, right?
Many.
Like and if you had a bad experience in stocks in 2022, in 23, you saw some GIC yielding 5%. You said, get me into that. It's a risk-free investment.
Mhm.
I'm getting paid 5%. Looks pretty good. So, those people were not alone. In the US, there is $6.3 trillion today
Mm.
in US
Wow.
money market fund assets.
Mm.
By the way, that number is up about 33% or just over $2 trillion since January of 23. So think about
Mm.
that. It's only been 20
Mm.
months and we've seen $2
Wow.
trillion move into money market funds.
Right.
So I believe that number is not going to come down, but it's not going to rise at the same pace. If you look at a chart of money market fund assets, it never comes down
Mm.
because people put assets into
Mm.
money market for all kind of different reasons.
Mm.
But if it were to subside, the marginal dollar will start to look at equities more attractively. And I think that's going to be increasingly true as interest rates come down. So as that rate comes down and you're no longer making 5% on your GIC and it's going to be 4 and 3, you're more likely to apply that next dollar into dividend stocks, like you were saying. So I think that's going to be a nice tailwind to equities when we finally do see that.
Mm.
Now, bonds, I think, in this environment continue to. I'm a believer that I'm an equity investor, but I believe that bonds have a very important role to play in a diversified portfolio. All things being equal, you're right; they do well in an environment with lower rates, and rates are going lower. But I think that where you're going to really like to have bonds in your portfolio is when you do get a recession. So, when you do get that 30 to 35% bear market in equities, we don't think that's happening imminently. If you look at, we just started the third year of this bull market, and the average bull market in the last 75 years has lasted just over 5 years. And so, we think that, there's still room to go here. But eventually, a bear market associated with an event with a recession comes, and when that comes, that's when you want to have bonds in your portfolio, because that's going to buffer your downside to the market.
Yeah, absolutely. I mean, all our discussions usually talk about risk first. The risk return conversation is always together, and I often lead off with risk. So bonds definitely as people are aging, they need to provide income, they need access to capital that they're going to draw. So bonds provide safety, not just returns. So even when it was 1.5%, that's not the only purpose of the bonds. It was also for safety and providing short-term income over a couple of years, because you can wait out the markets over 5 years or more. But if you want a bucket of money you need in the next couple of years, they serve a useful purpose for that, for safety, as you say, during market declines.
Yeah, no, absolutely. It'll help smooth your overall ride. Like, I think equities do very well over a very long period of time, but there's a lot of volatility and emotions involved in that. And I think in order to smooth the ride, you want that mix of equities and bond in your portfolio.
Yeah. Okay. Well, I'm trying to keep it short today, so I'm going to leave it there. Thanks so much for joining us. I'd love to have you back, maybe at the end of the year for the fourth quarter, maybe early January, to do a year-end review would be fantastic. As my clients and people who work with me will tell you, I'm always nervous. I am risk averse, but I do see a lot of positive things going forward, regardless of elections, which hopefully won't cause too much trouble. But in terms of earnings, in terms of rates, and a lot of the fundamentals, I see some good things moving forward, at least for the next 12 months. So thanks, Jonathan. Thanks for joining us, and I'll talk to you again soon.
Sure. Thank you, everyone. Thanks for joining us.